Hello? Okay. I'm Casey Wagner. I'm a senior reporter at Blockworks, and yeah, we're going to be talking about custodians. So I'd like to kind of start with what is a fiduciary custodian?
That's a great question. So in custody, when we talk about custody, to summarize it just in a few words, fiduciary basically means having protection against several threats. The most important one against bankruptcy, both of the broker and of the actual custodian. This means that if something wrong happens, instead of having to go to a judge in whatever jurisdiction, you know, your custodian or your broker is, there is basically an established set of rules, checks and balances already determined by a regulator, so a third party that we should, in theory, trust to give back the client's assets without too much hassle. There's always some hassle, but less than, you know, spending 5 years trying to collect those assets and recover them.
So when we have, for example, exchanges collapse or close or shut down trading, why does that kind of emphasize the importance of safety and custody?
Sure. I guess we can now, after a few months, we can all start saying the word FTX again, right? That's okay. So no one's blood pressure goes up anymore, or just a little. So let's put the FTX example. I think is the best way to explain it. So in traditional finance, whenever you access markets, there's generally what we call a market structure, right? There is an exchange on the one side, a clearinghouse on a separate side, different entities, very separated. There's settlement agent, also separated entity, and there's a custodian. That's a general setup of how trading happens. We can go deep into how derivatives trading happens, spot trading, etc., but that's the main idea. What does this bring in TradFi? This was invented years ago, 1940s, okay? This brings security, both from a technology perspective, financial perspective, AML risk compliance, right? What has happened in the crypto industry until these days, I've been around since 2016, built the first regulated custodian ever called Sapo, not a custodian anymore. This didn't happen. This market structure wasn't there when all this started, right? So you had in the same player, the exchange, the broker, the custodian, the settlement agent, everything. So what does that mean? Risk, 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 risk everywhere. No one has invented the wheel with fiduciary regulated custodians. What BitGo is trying to do, another regulated custodians, not too many in the industry, is basically assimilate or trying to mirror as much as possible this structure, not the intricacies of, you know, getting over blockchain and not taking into account what blockchain can bring into the industry, but bringing in some decent security into how we operate. So this means that when you operate in an exchange directly, and they do the custody, the settlement, etc., you are in the liabilities column of that exchange in their balance sheet, okay? Full stop. You're a liability to them. It's not your coins, it doesn't work like that. The exchanges don't have segregated wallets for you, it doesn't work for their business model, etc., etc. So how does TradFi has resolved all this? Basically, putting in the middle all these agents, clearinghouse, settlement, and specially custodians. So what we try to do at BitGo, and as well as other firms, is basically be that third party which has only one responsibility, which is safeguarding your assets outside of that broker, exchange, OTC liquidity provider, etc. And that is basically surveilled and overseen by a third party, which is a regulator in a jurisdiction which you trust, or which we trust, which, by the way, it's not always the same in different jurisdictions, right? Right now, custody regulation is basically not the same everywhere.
Yeah, I wanted to ask about that. You mentioned that there are so few regulated custodians. BitGo is a qualified custodian in the US. That's how we classify our custodial regulations. There are very few. What is the difference between jurisdictions when it comes to getting that regulated label?
Sure. So you're right. In the US, this was brought up in 1940. And these two words of qualified custody only exists in the US. Okay, outside the US, it's just regulated custody, or it has some other words, but qualified custody, it's solely specific to the US. So what has happened in the US is the following. Since 2017, there are state charters giving you that license, that qualified custody responsibility. Only in a few states to start with. The first one was South Dakota, where BitGo is regulated. The second one is the state of New York through New York DFS, called the Bit license, pretty famous. So these two states were the ones that basically started all these regulatory frameworks. They all can be improved, that is for sure. Okay, nothing is perfect, but those are the two regulators that bring the highest, let's say, regulatory standard to the industry in the US. There are other states bringing up and putting together their own regulations. There's some already that launched, and a lot of them are looking into it. Those are the state charters. The OCC, a year and a half ago, the OCC is the Office of the Comptroller of the Currency in the US. They issued the first ever federal state charter license for custody. Okay, the former president of the OCC decided that this had to be a federal charter, or that they have to give the opportunity for custodians to have the federal charter. So they opened up the applications. A custodian called Anchorage applied for it. It turns out that a few months after they were given the license, the president of the OCC left. No more applications were allowed. Everyone who applied were just told to stand by, and here we are still, like just waiting for them to tell us something. And also Anchorage is being sued by the OCC directly. So it's kind of a little bit, yeah, effed up, not to say something different. That's the US. So it doesn't help on top of Gary.
Would you say the US is the most strict?
I wouldn't say so, actually, okay? So outside the US, we have some examples. BitGo has five trusted regulated trust companies, regulated custodians right now. The other two are in Switzerland and Germany through BaFin. So the most stringent one, the one that most protects clients' assets, is the one that the German regulator put together, called BaFin. That's the name for the German regulator. It has taken us around 2.5 years to get the license. There are only 3 players in the market who have it. And that's basically what we think the market needs, right? Regulation is not just there for custodians or other players to market themselves as secure, okay? It's nothing about that. It's really about protecting clients' assets, avoiding a new FTX, and basically have a clear framework of what happens in terms of a process if something goes wrong, which will go wrong at some point over and over and over again because we're humans, right? So the BaFin regulation in this case establishes a pretty clear, not perfect framework of what would ideally happen if there's a bankruptcy or a hack of a custodian regulated by the regulator.
When you're filling out these applications and engaging with regulators in various jurisdictions, do you find that, are they asking the right questions? Are they, concerned about the right things when it comes to customer security? And then to counter that, are there instances where they're asking something of you that might limit innovation or access in any way?
So I would say in the last 2 years, they are more and more asking the right questions. They've hired their own digital asset experts, or their in-house people are ramping up pretty quickly. In 2017, 2016, when I first when we started, for example, Sapo in Switzerland, no one had a clue that, let's face it, right? No one really knew how to regulate this, what security for clients meant, et cetera, et cetera. I remember I wrote with FINMA, with the Swiss regulator, the first auditable process of how a Bitcoin transaction was going to be audited. Okay, so we were really making it up and working with the regulator as we went through it. So ultimately, they are making the right questions. There's still a lot to go, a lot of work to do. For example, I was mentioning before, what is the process, right, if there's a bankruptcy or something goes wrong? It's not exactly clear the way a tier 1 incumbent bank operating in 65 countries in the world would want. Okay, they are used to do their due diligences with all the legal opinions, all the checkboxes, etc. We're not there still, but we will. And we won't be there until the regulators ask the correct questions and we as custodians comply with it, right? What was your second question, sorry?
The other side of that, I mean, there's a lot of, from the US perspective, there's a lot of talks about policy right now in America that people say would harm innovation. They would hurt investors, they would hurt access, it would make it unnecessarily difficult for companies to operate. Are there any instances of that when it comes to custody regulation that you've noticed?
100% yes, and I'll give a very clear example. For example, and I'll go into the US in a second, that's gonna take a little bit more time. So MiCA in Europe, right? Everyone hears the word, we all know more or less what's going on, the new digital asset regulation in Europe. They don't touch nor even mention staking, DeFi, lending, borrowing, using crypto as collateral. Like, how do they want, like, there was a DeFi panel right before here, people talking about very interesting things around DeFi and how to improve a lot of things. How are we going to make our grandmothers to use this if our regulators don't tell us, like, how are we going to control all this, right? So people are talking already about MiCA 2.0. Regulators between the US, Asia, and Europe don't even agree on establishing the parameters of what is a utility token, what is an e-money, what is this, what is that. They can't even catalog the assets the same way. So, of course, that's a risk, and that's stopping us from actually moving faster, that's for sure. But not everything is black, okay? There's a lot going on in the US. Now let's go to the US about, Gary Gensler and the SEC, and the SEC is stopping innovation, and everyone is against him. Well, back in February, Gary Gensler and the SEC in general proposed an amendment to that 1940 Banking Act I mentioned before, which said, okay, all RIAs are going to, RIAs, I'm sorry, not native English.
That's registered investment advisors.
That's correct.
They help people access crypto.
That's
Sometimes
right.
It's a little difficult.
RIAs. So he basically proposed to apply QC, normal, qualified custody normal regulation for those RIAs who hold crypto, which is not a crazy thing to do, right? Like, if we're trying to mirror more or less the protections that TradFi have and that have protected investors since early this century, why are we not going to apply traditional asset managers at least the minimum requirements to safeguard clients' assets, right? So that's a positive note. And Gary Gensler taught blockchain and crypto. Again, not that we are in the crypto industry are super fans about him, that's for sure. I'm not going to do a qualitative, I'm not going to say anything against or for him, but there are things that they're doing right, and I would say most regulators we talk to are really eager to do things right.
I admire your diplomacy there. I could talk about regulation all day, but moving on to kind of the product side of it, in terms of institutional versus retail products, what's the difference? You mentioned that there really isn't one, so can you explain that?
Sure. So at the end of the day, it's just, when you talk about retail, it's just one more step. So retail accesses liquidity through institutions, exchanges, maybe not the kind of institutions we think about like banks, investment banks, asset managers, but at the end of the day, these are centralized or decentralized companies, even a DAO if you want, which give access to retail investors to those assets, right? So when we talk about giving custody to retail clients, there are two ways. The first way is called sub-custody. This is a model used in TradFi. So basically, the asset manager, let's put it simple, or the exchange, has an account with the custodian, okay? And ultimately, the custodian has the responsibility of all those assets as an omnibus concept, okay? The broker or the exchange has the ledger identifying the balances of each one of the clients, but the custodian basically holds the entire thing, right? That's the sub-custody model. There's another model, and BitGo is the only one actually that has it from a regulated custodian that actually has it, the B2B2C model, whereby, and this is all about what we're talking before, creating market structure. It's not done yet, okay? So we are kind of doing as much as we can to improve products and see how we can mirror the TradFi. So there's a way in which if you have a client operating in an exchange, that exchange would have an omnibus account at BitGo, but ultimately the fiduciary responsibility of the custody of those assets would rely directly on the custodian. And the custodian would have, and this is the most important part of it, the actual ledger containing the balances, the identifier, and the identifier, unique identifiers of the actual ultimate beneficial owners of those assets. So this is interesting. Why? There are new and old compliance requirements coming up. SAB 121, it's called in the US, SEC requirement, in Europe through the European Central Bank and the Basel requirements and MiFID. They are going to request all publicly listed companies offering this kind of services to have an actual regulated custodian to own that fiduciary responsibility of the client's assets. Meaning, if there is a publicly listed company wanted to offer a simple buy, sell, hold Bitcoin product to a client based or US citizen, based or European citizen, they are going to need, for sure, a regulated custodian, either through MiCA or European custody regulation.
So like an ETF issuer, for example?
Sorry?
Like an ETF issuer?
Right, okay. right, exactly. So from a technological operational perspective, this has only been figured out by BitGo for now. We already operate with this model in Germany with a few clients. And it's something coming up real quick. And that is one of the reasons, again, custody is kind of we can see the place, right? Not many people, it's a very boring thing, but it's a needed thing. And we're now seeing a lot of large incumbent publicly listed institutions that literally bump with this into this problem week one of strategizing for these products.
It's also happy hours, so we won't take it personally.
Yeah, and beers are out, so since 2 hours ago.
One last question, on that note, what are you guys working on? Can you share anything on the product front, what you're excited about?
Sure. So one of the exciting things is what I just mentioned, the B2B2C model. The other thing is what we call the Go network. So we're actually launching it in a few weeks' time. So we've basically built a global settlement network that would basically enable you get the best of liquidity providers and exchanges, which custodians don't do and shouldn't do, by the way, with the best of actually keeping your assets in regulated custody segregated from the liquidity providers and exchanges. This Go network has 3 main verticals. One of them is simple send. Okay, so imagine you agree on an OTC transaction outside of BitGo or maybe on the phone with your partner, with your client or your liquidity provider. If both parties have an account at BitGo, you can just send crypto or fiat inside the BitGo platform. Remember, when you're a regulated custodian, you're allowed to not only custody in a regulated way digital asset, but generally also fiat, which is a huge advantage. The second one is what we call Go Clear, which is the same but two-legged. So basically, you settle and you send the crypto and the fiat at the same time, similar to atomic swaps, but not on smart contracts. And then the most exciting one, which is the off-exchange settlement, which basically enables you to settle with your exchange without having to actually move assets to the exchange and have your assets as a liability of that exchange or liquidity provider. So you would basically connect your exchange account. You can delegate assets in that exchange. Assets don't move until the settlement time happens, either 2 hours, 24, depending on the exchange you use, right? So that's literally the most elegant way to remove all the risk from the exchange and get the best of regulatory custody. By the way, I do think we're gonna see more losses of digital assets. It's gonna happen. I'm pretty sure, again, I've been in the industry for 7 years now, and I still see very crazy things happening out there. I jump on calls with people, executives telling me how they do things, and I'm just shocked. And I have to say this, and I'm now, running around the world, giving these panels and talking about this, sometimes full room, sometimes this room, but I am personally worried about it. We are already working with 2 European regulators to liquidate 2 more players. And business is keeping on coming. That's money for us, but not something that we really want to do. And, after FTX, which we were 2 hours after we were assigned by John Ray III as the liquidators, has triggered an entire, free fall of regulators, financial regulators, etc., who have no idea about crypto to look into these companies, and they're unfolding a lot of stuff.
It's alarming. Well, I hate to end on a negative note, but thank you so much. I really appreciate it.
It's not negative. It's just life. We're just working to improve it.
Okay. Well, there's something for us all to be watching. Thank you.
Thank you very much.
Thank you, Casey. Thank you, Joaquin.